Good morning and welcome to the street today, here from Post 35 on the floor of the New York Stock Exchange. It is Thursday, February 9th. I'm Katherine Ross, filling in for JD Durkin. We are about 30 minutes into the trading session, and it's the first time this week that I get to say the markets are trading higher as investors continue to react to a flurry of better than expected earnings and better than expected jobless claims. On the show this morning, we'll talk housing as experts predict home prices to plunge in 2023. Plus, we'll dig into Disney's first quarter results as the House of Mouse unveils cost-cutting measures. And finally, Alibaba is betting big on artificial intelligence as the AI arms race continues to heat up. For more on these stories and so much more, let's bring in our special guest, Ross Mack, host of Maconomics. Now, Ross, as I said, markets are trading higher today. What's driving investor sentiment this morning?
Hey, Catherine, thanks so much for having me. I think when we think about investor sentiment, this entire year, right, effectively has just been effectively a bull market. And I think a lot of the things that really go into that is the fact that earnings are coming in better than expected. Inflation obviously peaked last year and is starting to come down, and people have an overall vote of confidence in the economy.
So far this week, I've asked pretty much every guest, and I'm curious to get your take on this. You just said we've effectively had a bull market so far this year, so you don't think that this is a bear market run. You really think that maybe we're pushing into a bull market territory?
I use that term loosely, but by definition, right? Obviously, like the Nasdaq is up over 20% from its lows, and so by definition, we are past what would be technically, a bear market rally. However, there are things that I'm still cautious about, but overall, the market has been a ton of short covering, and like I said, people have literally so many analysts this past year were effectively saying, "Oh, it's going to be a recession. S&P 500 returns are all going to be flat, 0% returns, etc." And however, earnings are coming in better than expected. And like I say, there's just been an overall vote of confidence from an investor standpoint.
As we all know, the Fed has really been driving the market headlines so far this week, so far really this year, if we're being honest. And now some investors and analysts are betting that the Fed could actually raise its federal funds rate to 6%, and that's about a full percentage point higher than the current consensus. Do you view that as likely?
I think it is quite likely. And the reason I say that is just given the fact that we're nowhere near the inflation target of 2%. And as a result, you got to ask yourself, where are we as an economy? The intended consequences of the Fed raising rates is to slow down demand, to slow down wage growth, to slow down job growth. And as you can see, we are at a record low. Over the past 50 years, we haven't seen unemployment this low. And inflation obviously is slightly coming down, but it's not coming down quick enough. And so the only thing that the Fed can do in this case is continue to raise rates. And so the original 5% target, it might get closer to 6%.
Now, Ross, outside of inflation, outside of the Fed, one of the other big parts of the economy that people are focusing on is the housing market. And that comes as Ian Shepherdson, who was an economist famous for predicting the housing crash in 2008. He's now forecasting that home prices could plunge another 15% this year alone. If home prices continue to fall, what could that mean for the overall housing market?
Well, I think there's no ifs, ands, or buts about it, right? 2022 was it was hot, right? We came off record highs when it came to prices in the housing market. And obviously, the counterintuitive point of raising rates is to slow down demand, consumer demand. And obviously, as rates get higher, there's going to be a lack of refinancing. There's going to be a slowdown of people wanting to purchase new homes, right? You think of the beginning of 2022, 3% rates, now over 6%. It got as high as 7%. And obviously, the outlook is that the Fed will continue to raise rates. And so, by definition, housing demand has slowed down. There's probably more supply than demand. And as a result, prices have to come down. I don't think we're going to have '08 levels of distress when it comes to housing. I don't think there's so many home buyers that are over levered, or I'm sorry, homeowners that were over levered that they were like in 2008. However, I do believe the housing prices will come down as demand is obviously slowed down, just granted by the higher borrowing costs.
Well, I can see my senior producer here at the NYSE breathing a sigh of relief as he's trying to get into the market. And I myself am involved right now in the trying to close on a house, and it's pretty wild out there. Outside of our personal anecdotes, Ross, it always makes me wonder, why is housing market data so important to pay attention to, and what kind of clues do you take away from it to understand better the state of the economy?
Well, housing market, housing data is very important. Just granted, is giving you the overall strength of the economy from a consumer standpoint, right? People are willing to buy homes when they feel more confident about the outlook from an economic certainty standpoint. And obviously, there's a ton of uncertainty, just granted the imminent idea of there being a recession. So when you have people not as inclined to want to borrow money, that is obviously something to start paying attention to. However, right, there's been a lot of data points that's showing that despite prices are obviously housing prices coming down from all-time highs, there's still a little bit of consumer strength, right? You saw even, Uber CEO, where every other analyst on the street is saying, well, personal consumer debt is rising. If you look at credit card balances, if you look at savings rates are down, but yet when you look at, certain companies in the travel sector, whether it was airlines or the Ubers of the world, consumers still have a decent amount of confidence. They're still spending money. So when you look at housing data, it obviously is slowing down, but you got to look at it from a relative standpoint. It was extremely too hot. Coming post pandemic, everyone was in their house. Everyone was in a demand to move to hot spots, that being where you could just truly enjoy your house, get more bang for your buck. And so now, as we start to slow down, I think it is obviously a telltale, but I don't think, we want to look too much into it yet.
I want to switch gears here and dig a little bit into the Disney earnings. And with that being said, we did just see a headline cross our wires that apparently, according to CNBC, Peltz is giving up the proxy fight for Disney, which means that the activist interest that's currently there is going to dissipate. Outside of that, Ross, we did have the company beat on both the top and bottom lines. Its streaming division, however, reported its first ever subscriber loss since its launch. What do you make of this report?
You just got to say two words, right? And that's Bob Iger. I think him being back was an extreme vote of confidence. He obviously came in, restructured the business, right? And I think that when you look at what Disney is, it was obviously one of those investment plays that you were able to benefit from the best of both worlds. That being when people are locked down, work from home, people were able to utilize Disney Plus. Now, as the world is opening back up, travel, seeing Uber having its best quarter ever, right? People are back outside. However, you got to look at the other parts of their business, that being the entertainment aspect, obviously the parks. So when you look at what Bob Iger was able to do, he was able to get Peltz to say, let me relax. I think he's doing everything that was needed, because they were obviously too aggressive in spending going into these past few years. And now that he's back, I think some of the cost-cutting measures that they're doing is obviously great, right? I want to say they're cutting $5.5 billion. So when you look forward, I think that they will continue to benefit from Bob Iger being back in place.
Do you think it's going to be enough to distract from the investor, the way that investors have been paying so much attention to these Disney Plus numbers? Do you think Iger kind of resets expectations for investors there?
Well, I think what you see is across the board, right? Across the board, subscriber growth has slowed down drastically. Obviously, Netflix had some strong consumer growth. Well, I'm sorry, subscriber growth, and that's obviously just given the fact of having a freemium model where But at the end of the day, if you look across the board, subscriber growth is slowing down, and when you have other ancillary products that will obviously benefit from people not necessarily watching Disney Plus, but maybe watching ESPN or maybe visiting parks, going to the movies and looking at some of the Disney movies in general, right? You get a little more confident because that business model is much more diversified.
Ross, with fears of an economic downturn, do you think that a company such as Disney is well positioned to handle a recession?
Is Disney prepared for economic downturn? At the end of the day, right, the vast majority of their products, right, you need the economy to be doing well for parents to want to take their kids to the Disneylands of the world, right? However, or Disney Worlds and Disneylands. But when you look at some of their entertainment business, right, those are the things that, for the most part, can benefit from, TV ads, etc. But at the end of the day, right, economic downturn will for surely slow consumer spending money in some of those products, right, in some of those areas. But at the end of the day, I do think that they are well positioned in the sense of having a more diversified business offering set. But if we're in a recession, I'm not taking my kids to Disneyland, right? However, is that going to slow down sports? Is that going to slow down ESPN? No. Well, maybe will I potentially slow down on some of my subscriptions to a Disney Plus? Potentially. So, there are obviously areas of the business that could very well be impacted, but they have a more diversified offering that could stomach some of the downturn better than others.
Now, Ross, as your producer for the videos that you do over on TheStreet social media platform, specifically Instagram, I know you've been covering a lot of this earnings season and what analysts have been expecting. Now that we're over halfway through with over half of the S&P 500 companies reporting, what is your overall outlook on this earnings season?
Well, when we look at a number of big companies, beating earnings expectations, we got to obviously understand that their outlooks were pretty mild and pretty low. So, when you look at it on a relative basis, it was probably easier to beat earnings, just given the fact that a lot of people bought their earnings down, their earnings expectations down, and forecasts down. However, moving forward, I do believe there are a number of things that could make people start spending less money, could make earnings start coming down. And that's just granted the tailwinds of possible recession, the tailwinds of the Fed continuing to raise rates. And so when we start looking at bigger name companies doing a lot of aggressive cost cutting measures, looking at the entire tech sector effectively downsizing their businesses, there are a few things to obviously be concerned about. But from a consumer staple standpoint, we're seeing consumers, regardless, still spending money in those areas that they deem important to them, as well as those inelastic products that they need on a daily basis.
All right, Ross, I'm going to put us back in the seat of economic data because this morning we did get U.S. jobless claims climbing 13,000 to 196,000 last week, marking the first jump in 6 weeks. Is this evidence that those tech layoffs are finally really starting to materialize in the economic data we're seeing?
Well, that's the thing, right? We've realized that the jobless claims number is a lagging indicator, so it definitely takes some time. Coming off last week, seeing 500,000 jobs being added, it's one of those things where it's like, is this a good week or is this a bad week? So obviously, only time will tell. But I think we all do understand that jobless claims happens to be a lagging indicator, and maybe tech jobs is starting to show. But I think we got to understand jobs in the service sector. There was such a strong bid for getting workers, right? There was a time where people couldn't get workers in the building, whether it was because they were making more money being unemployed. But now, right, it hopefully is starting to show. But I think, you just got to look at it and say it's a lagging indicator. And hopefully, we're starting to get a slowdown in jobs.
Well, and even when we look at that job number that we got back in January, this market is historically hot. What does the job market need to look like for the Fed to be satisfied?
I mean, for the Fed to be satisfied, we just got to get unemployment closer to 5-6%. And how do we get there? I mean, obviously, the Fed is increasing rates. I don't know how much further they need to go. But look, once again, what we're seeing is that inflation is coming down, it's coming slower, and wage growth is starting to slow down as well. And so at some point, there may be an equilibrium where, other sectors in the industry begin to slow down as well from a hiring standpoint and actually turn to cost cutting measures as well, similar to the tech industry.
Now, Ross, I know that financial literacy is an incredibly important topic for you, so I want to get into a little bit of questions surrounding that, starting actually with whether or not you view this current environment as a good buying opportunity.
Well, if you would ask me a month and a half ago, I would say absolutely, right? At the end of the day, it's very important to understand what your investment horizon is, right? If I am nearing retirement tomorrow, I'm thinking I'm going to take advantage of higher rates and get some very sure smart investments, right? Lower return, but much um, lower risk as well, right? Thinking about fixed income, thinking about high yield savings, thinking about bonds, etc. However, if I am a young investor where I have 20, 30 years, absolutely it's a buying opportunity. Now, would I buy today? Gun to my head, no. I would probably wait until there's a small pullback. But at the end of the day, I think we all understand it's nearly impossible to truly time the market. And if you were trying to time the market and you listen to every other analyst across the street this past year when they were forecasting flat S&P 500 returns, then you probably would have just stayed on the sideline and actually would have missed this strong rally for this first almost month and a half of the year. And so at the end of the day, right, I think it's impossible to time the market. What you want to do is be disciplined and consistent and invest on a monthly basis. And I think when you look when you look 5 years from now, 10 years from now, some of the great companies that you buy, technically still at a discount, right, you'll be happy that you did it.
And what about specifically the tech sector? Is that also your approach there with all these names well below their all-time highs?
Names are Many big names are well below their all-time highs, but they have obviously grown aggressively since the beginning of the year in terms of getting a strong bid, right? You see some big names up over 100% year to date already, right? If you look at the Teslas of the world, the Nvidias of the world, it's been a strong buying appetite out there. However, right, will they come down? Potentially. And I think that might be a strong pullback. If you look at it from a technical standpoint, RSIs are getting close, if not over 70, which is a good indicator of saying maybe it's time to slow down, right? Maybe the market is a little too hot right now. But nonetheless, if you're looking at it on a long-term standpoint, and I love the way you looked at it, right? From a 52-week high standpoint, you still have names that are well below over 50% down. And so you still have the ability to buy some great names and just sit back and be patient because this is a patience game, right? At the end of the day, once you get into the investment standpoint, it's not about timing the market. It's all about time in the market.
Now, I know it's no longer the new year, technically, but we are still pretty early on in 2023. What are some of your tried and true investing tips to carry through this year?
I'll reiterate exactly what I said. The tried and true investment tips is time in the market as opposed to trying to time the market, right? And what I mean by that is just literally understanding that, statistics are on your side, history's on your side. When you buy great companies that have a competitive advantage, that are in a position of growing sales, continuing to innovate, you buy those companies when you see them down 30, 40, 50, 60% down, right? You literally take the same mindset that we're trained as consumers to see a sale, to see a Black Friday or Cyber Monday sale. We do that. We apply that with great companies as well. But also from a tried and true standpoint is buying companies that have a strong ability to provide inelastic products that consumers are going to need, whether we're in a downturn or not, right? At the end of the day, I think we do see, and despite, what Uber's saying, right, I think we do see consumer debt increasing, and we're also seeing savings decline. So at some point, and obviously inflation's still high, right? So at some point, cash-strapped consumers will begin to slow down and begin to maybe invest in maybe generic products as opposed to, some of the brand names that are a little cheaper. But at the end of the day, right, tried and true is buying products that have a competitive advantage, that have inelastic demand, and brilliant companies that continue to innovate.
And finally, Ross, I know we talked about tech, but outside of that, what are some of the most attractive sectors on Wall Street for you?
Depends when you ask, right? I think right now, the hottest sector, I won't necessarily say attractive, the hottest sector is obviously artificial intelligence. But what I will say from a risk adjusted standpoint, I think you can get a ton of, going back to those inelastic demand type products, you can really start looking at a few energy as well as pharmaceutical companies that are going to give you strong dividend yield while also giving you the ability, once again, to say, I own a product that whether people have a lot of money or they don't, they're going to need this product, right? If I break my arm, I'm still going to the hospital. If I need an insulin shot, I still am going to the pharmacy. So pharmaceuticals, healthcare, those are strong products. AI is red hot. I do believe there will be a pullback, and then there will finally be, okay, who has emerged as this true, tried and true player, right? If you look a year ago, EV was the hottest sector. Call it 2, 3 years ago, marijuana stocks was the hot sector that everybody was just rushing to get to. But there will obviously be a strong pullback. We saw some names that people never even heard of that were up over 100% year to date too, and obviously they've came down. But AI is the hottest sector. However, in terms of some of the best risk adjusted sectors, still like the energy, the hospitality, pharmaceuticals.
Ross Mack, host of Maconomics, thank you so much for joining us today. And you guys can also find him over on our the Street's Instagram page, because Ross is constantly each day posting a new video on a slew of market relevant topics. So Ross, thank you so much for joining us today.
Thank you so
much. And coming up, we'll bring you. I know, it's so nice to be with you. All right, coming up, we'll bring you the latest headlines on the AI arms race and rumors of a crypto crackdown. But first, in a sneak peek from Action Alerts Plus, we sat down with Bruce Kamich, renowned technical analyst and chartist, to discuss the biggest mistake new investors make when looking at a technical chart. Take a look.
Bruce, when you look at a stock chart, what is the very first thing that you're considering?
Okay. Always consider the trend. Okay. It's your first reaction. Are they moving from the lower left-hand corner to the upper right-hand corner, or they're moving from the upper left-hand corner to the lower right-hand corner? Okay. Too many people that are learning about technical analysis rely on indicators. They like the sort of math-driven, the quantitative preciseness of numbers. Okay. Moving averages are black and white. There's no gray area for that in indicators. Charts tend to be kind of gray, and people maybe either lack an imagination or not focusing on the trend. So I like to look at the trend first. I like to look at 3 different kinds of charts, because no chart is perfect and does everything. So I like to look at a line chart, a bar chart, candlesticks, point and figure, and also on at least 3 different time frames. Most people are short-term focused. They'll look at a daily chart. You need to look at a daily chart, a weekly chart, and maybe a monthly chart, and understand that maybe this sell-off is just a dip within an ongoing longer-term trend. You really want to be a buyer of it and not be bearish on it. And I think that gets lost in today's society that wants a shorter-term focus and numbers. Indicators are just derivatives of the price action. So the indicator may be screaming buy, but if the trend is still pointed down, it doesn't mean anything. It's like we need to respect the trend first.
Thank you to our very own JD Durkin and Bruce Kamich. And now let's get you caught up on some of the biggest stories we're watching at the street. Alibaba becoming just the latest tech giant to bet big on AI. The Chinese e-commerce giant announcing plans to launch its very own AI-powered chatbot tool as it looks to compete with viral chatbot ChatGPT. Alibaba said the bot was not testing in its testing stage, but has not shared any details on its name or when it would launch to the public. This comes as the AI arms race continues to heat up. Just earlier this week, Microsoft announced an AI version of its Bing search engine, and Google launched its very own ChatGPT rival Bard, although investors were not very happy with that one. And as fears of an economic downturn mount, so do the tech layoffs. Names like Disney, eBay, Zoom, and Affirm all announcing layoffs this week as those companies scramble to cut costs during Disney's first quarter earnings call. Chief Executive Bob Iger announced plans to slash 7,000 jobs in an attempt to reduce spending. Zoom also announcing a big round of layoffs, with job cuts set to claim around 15% of its workforce as the company looks to right-size following its explosive growth during the pandemic. eBay also announced layoffs. The company announced plans to lay off around 500 workers, amounting to 4% of its workforce. And finally, Affirm announced plans to cut 19% of its workforce after its second quarter earnings came up short. So far, it's estimated that close to 100,000 tech workers have been let go this year alone. The CEO of Coinbase warning that a big crypto crackdown could be on the horizon. Brian Armstrong, who leads the crypto firm, said that he's heard rumors that the SEC wants to ban retail investors from crypto staking, which would hurt the brokerage and the second largest crypto, Ethereum. Ethereum staking refers to a technique that is used to help generate income for blockchains, including Ethereum. Armstrong said that the move will be a, quote, terrible path for the U.S. if that is allowed to happen. That'll do it for The Street today. Thanks again to our special guest, Ross Mack, host of Maconomics, for joining us this morning. Stick with The Street for more on these and all the other major market stories that matter to you, and we'll see you tomorrow.